Welcome back to my channel. This is going to be a very short video on how I calculate the value of an entity according to the free cash flow method. I hope that you find this video useful. Pretty please subscribe. If you're already here, why not just press the subscribe button? I'm just going to give a summary of how I approach a valuations question and just give a bit of tips on how to handle a valuations question. So I came up with a basic example that I made out of my own mind, and usually if they say starting with profit after tax, you don't have to do a separate tax calculation. So let's just say, for example, profit after tax at 2020 is 200, at 2021 is 220, and at 2022 is 240. What you need to remember when calculating the fair market value of an equity using the free cash flow method is that you want to calculate the net present value, obviously using the cash flows. Now, cash flows of a company are the day-to-day operations of a company, and those actually exclude your interest expense and your investment income typically. So the point of reversing this is to make sure that you're calculating the value according to the day-to-day operations of that entity. So I just came up with a basic example, and this is profit after tax. That means that the interest expense is already included in here, and the way to reverse that is to add it back, because accounting treatment would have deducted interest expense. So we add that back and pretend that that didn't happen, and then because this is profit after tax, you have to make a tax adjustment, obviously at 28%, and that comes to 6. And if you think about your accounting treatment, you will know that adding back an amount to profit after tax will obviously have the opposite effect to your taxation. And then let's just pretend that investment income is 15, and this is obviously a minus because investment income would have been added, and we want to reverse that. Thus we just do the opposite and we subtract, and the taxation will have the opposite effect, and it will be a positive cash flow of 4.2, which you can just round to 4. And then typically depreciation gets reversed as well, and let's just pretend that is 25, 35 and 40. It is also quite important to remember that you're calculating the value of the entity at 28 February 2019, and this will always be cash flow 0, and nothing happens there usually. And then comes your capital expenditure. This is quite an easy calculation, and you can actually get quite a few marks if you just understand what it is about. Usually every valuations question is very, very different, but I do believe that if you understand the basic principles, you can scoop quite a bit of marks in this section. Capital expenditure is basically, it's usually in most cases going to be a negative outflow because it is referring to the amount of money that they spend on buying property, plant and equipment. And it is also quite important to note they could make it very easy. They can give you this amount, so they can be kind enough and tell you that, okay, your capital expenditure on PPE was 10 in this year, it was 12 in this year, and it was 14 in this year. But it is also important to note that you might be given a statement of financial position, and in that case you have to draw a T account. That's what I do, and you must remember that PPE goes up on the debit side and goes down on the credit side, and that means that you need to put your opening balance here, your closing balance. If there was additions, you add them here. If there was disposals, they come here. And depreciation obviously comes on the credit side. So what you do in such a case is that, let's say for example, you had 100 opening balance, 200 opening balance. You can see that your property, plant and equipment has increased, meaning that they spent more on property, plant and equipment, and that would obviously be a negative outflow. The next calculation, which is always quite a lot of marks, is the net working capital. That is quite a very much doable calculation, and I'm just gonna write here calculation 2 and show you how typically it is. They can be kind and give you these amounts, but they can also expect you to calculate them yourself. Now, net working capital is simply your current assets less your current liabilities. That current assets is obviously your inventory. So let's assume that we got current assets of that and current liabilities of this. This can either be easily given, or you have to look at your statement of financial position to determine which was current assets, which was current liabilities. And when I say current assets minus current liabilities, in 2019 I get 20, 2020 I get 30, I get 20, and then I get 40. So in your cash flows, you actually want to take the movement. So we use the movement and not these amounts. From 2019 to 2020, the net working capital increased. We know an increase is actually negative, so that your movement in that year will be negative. And then in 2021 you had a decrease, so that would be 10 positive, and then in 2022 there was a 20 increase. And then these are the amounts that you put in your cash flows. That will be minus 10, positive 10, and negative 20. I believe when you're calculating, when you're doing valuations, it's important to remember all the steps. If you don't remember all the steps, you'll struggle to approach a valuations questions and you'll probably get very overwhelmed. So what we do, we add up, and when I added up, I got 204, 252, and here I got 245. There isn't actually that many marks for getting the totals correct, so you don't have to be too worried. Then the terminal value becomes the next big calculation, and it's important to remember the formula for how to calculate the terminal value. The calculation for the terminal value almost never changes. It is always the free cash flow total that you got at the end of 2022 times by the growth divided by the weighted average cost of capital minus the growth. Let's just assume that we got 245 times 106 over 16 minus 0. Over 16 minus 6%. Actually, let's assume we've got 105 over 100, and 16% minus 5, and then that comes to, this would give you 257.25 divided by 0.11. And this is when they make your typically they make this complicated by asking you to calculate WACC. I've already done a question on how to calculate WACC. I'll leave the link in the description box below, but for this section they could ask the long how to calculate WACC question, or they could expect you to remember that K, cost of debt plus cost of equity, is equal to WACC, and you have to remember all the different formulas for KE, and also remember that WACC is always calculated according to the weight, and that is according to the debt to equity ratio and stuff. So that is doable stuff, but it's just important to note and to remember so that you don't end up getting overwhelmed by these questions, because they can get very, very lengthy. So this gives me a terminal value of 2,338. Then we come back to our cash flows calculation and we put the answer we got for our terminal value as 2,338, and then what's left is to just add all these totals up and to get the answer for those cash flows, which is 2,584. The value of your entity, you take the answers you got, your subtotals, and your interest per year that you use is your WACC, your weighted average cost of capital, which we just made 16% as an example. And once you put that in your HP or whichever calculator you use, you get a net present value of 2,119. And this is when there's quite a few marks that you can obtain when it comes to the end of this calculation. And you have to then remember that the market value of any entity is usually equal to the net present value, or the value you just calculated it according to the free cash flow method, or maybe you use the earnings per share method, whichever method you use, and then that is plus the market value of your preference shares. It's plus cash you have at bank, but it is always minus the market value of debt. So what you do, you put this answer here, you say market value of entity or equity, whatever, and then you say market value of debt, whichever it is, you put that out there. Of course, it's important to remember that you can be required to calculate this, and they don't always give you the cash at bank. Sometimes they want you to determine the value of the investment amount, but it's just about being aware of that. It's not necessarily difficult. I remember there was an example which had the investment income was actually based on cash at bank. So they told you that it was 11% that they earned as investment income, and all you had to do was to take the interest which was given divided by 0.11, because it was 11%, and then that gave you the cash at bank that was being used as investment income, that was being used as an investment and what they were getting investment income from. And if you are obtaining, let's say 60%, you're going to add a control premium that can be like plus 5% of the balance, and there can be also something called a marketability discount, which can be like 7%, and obviously that's a minus. This is usually when the entity that they want to acquire is not listed. So they can actually be like up to 5 marks for this section for just simply remembering this. I find that valuations are really not that complicated. They are quite doable. I remember there was this series I loved to watch, and it was called High Rollers, and it is also just good for you to visualize what valuations are about, and to also note that they can easily integrate this with auditing, because the person who values an entity has to be independent. And I remember in this series, the lady who was valuing the casino, I don't know if anyone ever watched High Rollers, she was not independent, and she was a very shady CA. So it's just good to visualize these things, and yeah, it can be as simple as that. It can be more complicated, but I think if you know the general process, you should be able to scoop a pass or scoop quite a bit of marks. Thank you so much for tuning in. I am done with this video.